Hello, everyone. Welcome back to our discussion for Accounting 150. We're going to be talking about Chapter 2 and just to introduce and talk about the accounting principles. And as we do that, who is the Financial Accounting Standards Board, or the FASB, as they are sometimes affectionately known? So let's jump in and talk about the principles that guide accounting. Okay, remember that we talked about the idea that there needed to be rules when we want to communicate information. There has to be some standards about how that is presented so that we can make comparisons, so that we can all be talking the same language, if you will. But there may be some misunderstanding that accounting is an exact science, that we are worried about every penny and so forth. And I want to make sure you understand that while we as accountants want to be exact when we can, we understand that that is not possible in many cases, and that financial information is used to get a picture. Your textbook talks about it being a painting of what's happening with the company, the financial health of that company, and I've got an example here between a painting. We all know that a painting and a photograph are not the same thing, and that the painting may be different in small ways, and some paintings in big ways, but small ways from an actual photograph, which is as close as we can get to the exact image of whatever it is we're trying to represent. So the key is, can we see who it is? Can we recognize? Are we close enough in our representation that we can make a fair judgment as to the financial health? And the other thing we remember is that financial information is good if it represents what's really happening. It's not good if it shows that the company is wonderfully successful. It's only good if it shows that they're wonderfully successful if they really are wonderfully successful. We talk about it being transparent. Transparent is the idea that you can see through it and see what's really happening. So we want financial information that is transparent, but it does not have to be exact. And in some cases, we will get a better picture by an estimate than we will about waiting for exactness. That does not mean that we do not want to know exactly how much to pay an individual employee for a payroll or something like that. Those areas of accounting are exact, and we try to be as exact as possible. However, we are not going to get completely bent out of shape if we are off in our totals by a few cents or dollars or things like that. And we will even extend that to our class. When we use numbers and things, we are going to almost always round to the nearest dollar, and sometimes speak in very round numbers, because that will give us the idea of what we're talking about without getting into the exact and worrying about the exact math issues involved. So we want to be able to see what's really going on. And that means that sometimes there needs to be estimates. And there's some examples in your textbook of when we have to estimate. And in fact, that will create a better picture than the exact results, because we don't know what the exact results are right now. That's in the future. So we're going to estimate what's going to happen and report that now in order to paint a picture of what, remember, we're trying to predict future cash flows for investors. That's what this purpose is. And so predictions, while not all we do, certainly are part of that estimation process. And any prediction, forecasts, whether it be the weather or anything else, is all based on estimates. And we don't expect it to be exact. We want the weather to get close. We want to know if it's going to be freezing cold tomorrow, But we don't get too bent out of shape if the high is 84 instead of 82 like forecast. And so the same thing happens with accounting. We can work with small errors. Now that depends, and it brings us to the term and concept of materiality. When we talk about how different we are from what reality is or what it's going becomes, um, if it's too small to matter, we say it's immaterial, and if it's big enough to matter, then it's material. Okay, but what determines that materiality? How much off can we be? Uh, how close do we need to be to get the picture that we're trying, that will actually be fairly represent what's really happening? Okay, um, that depends on multiple things, primarily on the size of the company we're dealing with, how many dollars and cents. So, what is material for Apple? So Apple um, had an announcement just a day or so ago that they are now, their stock of their company is worth $2 trillion, the largest, the biggest amount for any company ever. And what is material? What would make us different as to how we perceive their financial information is, for Apple, would be far different than it would be for a local garage that does auto repair. So Apple rounds their financial statements to the millions. Chances are you don't do that when you are looking at your bank balance and when you're looking at your kind of financial situation. I don't think too many of us are rounding to the millions. But that indicates that anything less than a million really is not going to make a difference in how you judge Apple's financial information. Now they're going to try to get it as exact as possible when they make estimates, and then when they have things that they are part of the financial statements, they're going to live with differences that we couldn't live with, that would be material for us or for a small business that isn't for them. And then the other thing is, what caused the difference? I think most of us would agree that we would be more upset by a friend stealing $20, even though $20 may be not a lot of money, maybe it is to some of us, but we would be more upset about that than if we just lost it. It dropped out of our pockets, or we set it down and it blew away or something, or fell off of the roller coaster, because there's an element of trust there, that $20. And so that's the same way inside a company. If you're off because of a mistake for a couple $100, that may be immaterial, and you may decide not to go back and fix it because of the effort is too much or whatever, if it doesn't follow exactly the rules in certain areas. But if it's because that somebody took it, somebody committed fraud, chances are you're going to take that much more seriously, and that would be material, because now you've got an element of distrust. Now you're not sure you can trust anything that individual or that process has to do with, because here it is that it disappeared and someone stole it. That means they could be elsewhere that we haven't seen or caught or understand yet. So it's not just the size of the company, it's also the reason for the difference. So we have an organization called the SEC. They were given authority by Congress to basically say, we're going to protect investors by creating rules or ways to make sure that the information is fairly stated. And so these companies who are going to sell their stock on the stock exchange have to report to the SEC. You've had a chance to look at a couple of those. Last chapter, Starbucks, and present these financial statements that we're going to learn about. SEC has in turn delegated the rule setting to an organization, a private organization called the FASB, or the Financial Accounting Standards Board. So if we go to their website, then you see um, their homepage here. You see their standards and the codification, which is where it's all organized. You also can learn about how they make rules, their meetings, their projects, okay, who they are, what they, their staff, their board members, all that good stuff is here on their FASB website. But their job is to set the rules, change them when things change in the world, so that these become the generally accepted accounting principles, meaning basically accountants need to follow them. And that they become, what people, now there's only 7 of the FASB, so that they're not enforcing them. The SEC still is the one that's going to come after you if you don't follow the rules. FASB is just a rule-setting body. Just like you might say Congress sets the laws in the United States, you don't have your congressman come arrest you if you break those laws. That's left to other folks. And that's the same with accounting rules. So they set general principles, and then as I showed you the codification on their website, that's where the more specific rules about how things are handled are involved. So some of the general principles that we all have kind of agreed on, and it helps us understand this communication process. First of all, FASB said that financial reporting is for investors and creditors. It's not for the government. It's not for employees. They all could use that information, but our primary focus is for investors and creditors. They're trying to make decisions about making investments or loaning the company money. So that information has got to be understandable to them. Now, that does not mean it has to be understandable to someone with no financial background at all. So there is the language, there is an assumption that people have a certain understanding of business and financial ideas. So it doesn't have to be, really basic, but it can't be so complicated that a reasonable person can't understand it. And then that information has got to be useful for making those decisions. So some things we will leave out because that's not useful for making decisions. Other things we will keep in because it is useful. To be useful, it has to be relevant. Relevant means it has bearing on the decision we're making. Relevant it has to be timely enough. You have to have it, receive it in time to make the decision. If you get the information 2 years later, it's too late. It's not relevant. If it has to do with something that you don't care about, it's not relevant. If it doesn't have to do with how financially successful a company is, it's not relevant. If it's too small to matter, it's not relevant. So materiality comes in here too. Reliable is whether you can trust it. Can it be verified? Okay, does it is close to being error-free as we can make it, and it's never going to be completely that, but that is our goal. Is it neutral, meaning does it try to persuade you to make one decision or another? We want the information to be just fair, not to try to make one company look really good and another company look really bad or something like that. To be relevant, it's also got to provide either feedback, meaning give us an idea of what we did in the past and how well we did with it, or how we're going to go forward and do in the future. All right. And then we have this underlying idea that sometimes we could get all kinds of information. We could get way more information, but the cost of getting it and gathering it and publishing it and everything would be too expensive for what we would benefit out of it. We wouldn't get enough good ideas as far as how the company's doing. It might be very detailed. It might be all kinds of stuff. But if it's not, if the benefit to receiving it is not worth the cost, then we won't provide that. So here are some assumptions, some general rules that kind of, you might say, buttress or go along with those earlier general principles. I'll give you a quick kind of preview, example maybe of each of these. Business entity, we have to keep track of which entity we're actually doing accounting for. So if some people have multiple businesses and we want to keep them separate. We want to keep the business entity separate from the owners in terms of who owns what. And as we report that, we want to make sure we do that. Sometimes we're worried about whether or not, if the shareholders, same shareholders own two companies, we actually report them together because they're controlled by the same folks. Or if one company controls another, they're reported together. That's all part of who it is that we're doing accounting for. And that's important because that's how we know what to include and what not to include. We can only deal with things that can be measured in monetary units. So we make a monetary unit assumption and we kind of assume that whatever monetary unit is for that area is what we'll use. So in the United States we'll use dollars, and if we're in Europe we'll use euros. And if we have a company that does business in Europe but is located in the United States, they may have to convert that to U.S. dollars after they do the business in Europe, and that becomes an issue for accounting. And we basically assume that $1 today is worth $1 tomorrow. We kind of ignore inflation under the monetary unit assumption, so that even though we intrinsically know that dollars buy less today than they did 10 years ago, we kind of just assume they're all the same because it's very complicated to try to adapt to that. Time period, that we can actually do our accounting in discrete time periods. There's a start and a stop, even though the business is continuous. Some businesses operate 24/7, but yet for accounting purposes, we kind of freeze everything at the beginning and end of a accounting period so that we can measure what happened, because it's really hard to measure a moving target. So we kind of have to say, this is the cutoff. This is where we want to take the picture of what's happening on this date at this time, and so forth. And that becomes our accounting or time period. We try to be objective rather than subjective, meaning we want to have evidence for what we have decided, what we report. We want somebody else to be able to look at it and come to the same conclusion we did. It wasn't just our opinion. Full disclosure, we want to present everything that would be relevant to making the decision. We're not going to hold something back just because it makes us look bad. We're not going to hide anything. We're going to give full disclosure. Obviously, that's more important with bad news than good news. No one has to be persuaded usually to tell good news. Going concern is the assumption that the business will be operating in the future. We'll find out as we look at some of the definitions of things that we are looking at that if the company is going to disappear tomorrow, those definitions will all have to change. So we make the underlying assumption that until we know absolutely differently, this business is going to continue to operate. We're going to learn about the matching principle a little bit more, and the idea that we're going to match revenues and expenses. And that will make more sense when we have a better definition. We understand that definition a little better. Revenue recognition, again, we'll talk about revenue, but the idea is we recognize revenue when it is earned, and we recognize expenses when they are used, not when they are paid. And revenue is not recorded when it is received, but when it is earned. And that will be an issue going forward. Conservatism really it's an underlying assumption, but actually the FASB kind of gotten away from it because they want us to be objective. They don't want us to be on the side of trying to make us look one way or another. Conservatism kind of pushes us one way. And what I like to say is if there is a situation where the choice is equal, you have to judge, maybe there are two possibilities, a way you can communicate information to the readers. And one makes you look better, and one looks, and it's literally equal chance of the two things happening. So you're predicting, maybe you make an estimate of the future, okay? And there's a 50-50 chance of them happening. You pick the one, remember there's equal chance, you pick the one that will make you look the worst. So if there's ever a surprise, it will always be on the positive side. And then consistency. If we're going to make choices and certain things disclose, we're going to do it the same way year to year and from company to company so that we can make comparisons. And then the last piece of these this kind of general principles are the definitions of these four accounting elements, which become very important going forward. This is what just, you want to dream about as an accountant, is what are these? And you can even practice every one of them as you think about your regular life and things you encounter just every day. Assets are resources that are owned or controlled by the business who bring future benefit. Liabilities are obligations that you owe and have to be met with resources in the future because of something that's already happened. Revenues is that inflow of assets that you have earned. You've done something, you've provided goods or services that have in turn allowed someone else to exchange resources. They've given you something. It could be a promise to pay you in the future. That would still constitute revenue. And expenses are simply the cost of earning the revenues. What is it? All of the things that go into earning our revenues. These become really the crux of what we do going forward, is the definitions here of these situations. Remember, assets can be owned or controlled. They have to bring future benefit. Liabilities they involve an obligation of giving up resources in the future. All right? And for example, let's say you buy a building and take out a loan. You have an asset, the building, because you control it, you own it, but you also have a liability for the amount you borrowed to buy that building. They really are separate things, okay, and fit the definition. So us being able to apply that definition becomes an important piece of what we need to know going forward. All right. Thank you.